Hello, I'm Farah Khalique, editor of Banking Risk and Regulation, your new digital service from FT Specialist. I'm joined today by Evgueni Ivantsov, chairman at the European Risk Management Council. Welcome, Evgueni.
Thank you, Farah. Thank you for inviting me.
You're very welcome. It's great to be talking to you today. Now, this video interview is our first collaboration to bring our audiences insights and key takeaways on the biggest topics in risk management. Today, we're talking about Basel Endgame. So let's get started. Now, Evgueni, the Federal Deposit Insurance Corporation recently released a rule proposal known as Basel III Endgame. The aim is to increase capital requirements for US banks with assets exceeding 100 billion. The regulator is seeking feedback from the banking industry. Many high-profile US banks have already expressed their criticism of the proposed reform. Tell me, what's your perspective on this? Do you agree with the criticism?
I broadly agree with skeptics, though for the different reasons. Most of the critics and comments that I've seen mention unintended consequences of this new capital rule, such as constraining of the banking sector capacity to support real economy, reducing attractiveness of the banking sector for the investors, increasing the cost of banking products for customers, and providing unfair advantage to the shadow banking. My prime concern is that this reform may not achieve the intended goals. One of the main objectives of the implementing these capital rules is to enhance the resilience of the banking system. According to the regulatory estimates, this will require banks to inject additional capital, incurring some significant costs for the banking sector. However, if we look at the problem from the more risk management perspective, it's not so certain that the additional capital that banks will inject can translate to the much greater stability for already well-capitalized banking system.
Thank you, Evgueni. US regulators claim, though, that the economic costs of higher capital requirements would be outweighed by the increased resilience of the financial system. I know you've expressed your skepticism about this claim, so could you elaborate for us?
Indeed, the proposal contains a statement that suggested increased resilience will overweigh the cost of this higher capital. However, this statement lacks of the substantiation that I would expect. Convincing arguments have not been provided to demonstrate that resilience will genuinely increase, leaving the room to challenge this statement. Just to remind you, the reform comes with substantial cost, and some estimates suggest that US bank will need additional 170, maybe $200 billion. So it's quite a significant amount. Regulators should bolster their proposal with the credible analysis that clearly demonstrates the performance of the US banking system under various stress scenarios, both with and without incremental capital increase. Unless such credible analysis is presented, I would argue that the law of diminishing returns comes into play. Let me explain. When a bank has a small capital buffer, each additional percentage point of the capital increase significantly reinforces its financial resilience. However, the same capital increase for well-capitalized bank, while incurring the same costs, might not significantly increase its chances to survive the idiosyncratic or systemic shock. Banks already more than double their capital base since the global financial crisis. And currently, most of the large banks are well capitalized. So take the example of recently failed Credit Suisse. Just before the collapse, Credit Suisse was a well-capitalized bank with a CET1 ratio of 14%. Even if the bank had 20% more capital, let's say CET ratio 16%, it might not have prevented the bank failure. This is because in most of the cases, banks fail not when they lose the capital, but when the market and customers lose faith in them. The ultimate resilience of the well-capitalized banks depends on other factors rather than capital. It depends on factors such as efficiency of risk management and robustness of its business model.
And your skepticism, is it backed up by any studies?
Yes, there are several studies that suggest little correlation between the regulatory capital and propensity banks to fail. So obviously, we are skeptical about this additional capital will increase the resilience of the banking system.
Now, back to the proposal from the FDIC, it does beg the question then, how much capital is genuinely necessary to enhance the resilience of the banking system? What factors should be taken into account when determining the optimal capital level for banks? And how does this proposal address those factors?
To answer this question, I think we need to look at on the fundamentals of the risk management and to think about banking resilience usually is ensured by interplay of two fundamental strategies: shock absorbance and shock avoidance. Regulatory capital as well as the liquidity buffer are the core of the shock absorbance strategy, designed to absorb the unexpected losses. The shock avoidance strategy is powered by risk management related elements, for example, risk culture, risk appetite, risk decision-making processes, controls, and governance. And these elements help to avoid or mitigate severe or catastrophic shocks. The shock absorbency strategy has its limits and is intended to absorb not all unexpected losses, but rather relatively mild losses. Building a capital buffer to cover very severe unexpected losses is economically unviable strategy. It's just suffocate the business. And it's inconsistent with the whole idea of the shock absorbency strategy. The majority of US banks today, especially large banks, have already sufficient capital buffer to comfortably absorb unexpected losses up to reasonable level, but would not have enough capital to cover losses resulting from the very severe or catastrophic events, even after the proposed increase of capital. And only the effective shock avoidance strategy can guarantee resilience in the case of very severe risk events.
So if an increase in capital does not contribute to the enhancement of financial resilience, what direction should regulators and banks jointly take to ensure the financial stability of banks, given the evolving nature of financial markets and the potential emergence of new risks? What should be the response, in your view, from a risk management perspective?
To build the very resilient system, banking system, we need to focus more on the shock avoidance strategy. That's the core of the resilience of the system. And shock avoidance strategy includes several elements, but the most important are the strong risk culture, robust risk decision-making and controls, and a sustainable business model. So these elements should be the center of the focus for the regulators as well as for the risk managers now, and only enhancing these elements, we can ensure that financial system is robust enough.
And to achieve this model, this business model that you describe, banks need to substantially improve their existing business approach. So in your view, what are the key elements of a resilient banking business model?
First of all, I think that there is no one model, resilient business models. There are several of them. And the idea why we have many different business models that might be resilient is based on the overall concept of the business comfort zone. Let me explain what I mean. The concept of the comfort zones is derived from the understanding that each company, each bank, each firm, especially one that with relatively long history of the business, possesses specific business areas that can be described as its comfort zones. These comfort zones can be defined as areas of business, products, services, where the company holds core competencies, competitive advantages and deep understanding of risk and effective control over the key risk factors and very effective crisis management approach. All of this is proven by the long and successful business track record, covering both benign period and the adverse periods. The longer the firm history of the successful business operation within the comfort zone, the greater its ability to mitigate risk and withstand various risk shocks. In contrast, the numerous historical precedents illustrate that extreme risk shocks are particularly destructive outside the firm's comfort zone, where the firm lacks of comprehensive business knowledge and capability to exercise effective control over the risk factors. So that is why for different companies will be different business models which are resilient. And firms should avoid the situation when they jump and change very quickly business model from one to another, because in this case, they're exposed to the extreme risk that might not control.
Now, Evgueni, you mentioned that one of the key elements of the business model should be a robust crisis management framework. But banks are already required to have recovery and resolution plans in place. So how does this crisis management plan differ from the recovery and resolution plans that are mandated by regulators?
Indeed, banks are required to have recovery and resolution framework in place. But when we talk about crisis management framework, it is a focus on the different stage, because recovery and resolution focus on the stage when or if the bank fails. But crisis management framework focusing on the stage to prevent the failure. So in this case, there are different frameworks and they have a different goals and different components. So when we talk about crisis management, especially if we talk about a robust crisis management framework, I would say that this framework should have 5 elements. First is risk crisis identification, or we can call it early warning signal tools that can help us to see that the crisis is coming and shift to the crisis mode. Second is contingency planning, where we need very detailed contingency plan. I call them WWWH, when, who, what, and how. And these plans should be prepared in advance, and people who are responsible for running these plans should know very well their responsibility. Next element is governance and resources. We're talking about the risk crisis governance, which is different from the normal governance, because for the normal governance, we have committees who meet on the monthly basis, quarterly basis, they need a quorum and so on. For the risk situation, crisis situation, we need completely different governance. It's sort of like military style governance, where we need smaller number of people, very powerful, who can meet very fast, make a decision and cascade this decision across the organization. And this governance should be also ready before the crisis, but not during the crisis. And the next element is IT system and management information reporting. We know that in the crisis, everything is going very fast. So we need fast information, but in addition, we need information should be structured in a different way. Because now we have the day-to-day reporting, which normally have a daily reporting, monthly reporting, quarterly reporting. It doesn't work in the crisis. What we need reporting driven not by calendar, but rather by events. And then we need much more flexible MI system, where we can easily extract information that we need. We can aggregate information in unusual way, slice and dice information, and send information for the decision makers in the very short period of time. And finally, the 5th element, extreme risk crisis communication. So communication is extremely important during the crisis, and we need to be ready for this communication. I don't want to say that we need to prepare the scripts in advance, but what we need to have the strategy for the communication, and each firm should define who are the speakers during the crisis, what should be the tone of the speaker, how often they should provide the updates, what information they should share internally, what information they should share externally, how they can provide the right information to external stakeholders like regulators, media, customers, and so on. And this information and this strategy should be prepared well in advance.
To sum up, Evgueni, what key insights should the banking industry and the public draw from the FDIC's proposal and the broader discussion surrounding capital adequacy?
I think that what we see is not the end game, as people say. I think that this capital rule proposal will not end the story with the capital management. We still need a discussion. We need more research to determine what is the optimal level of the capital that banks need to have to ensure the resilience of the system. And also the regulation on the capital should be much more flexible and reflect the fast changing situation in the economy and in the banking sector.
Well, it's been wonderful talking with you, Evgueni. Thank you for sharing your insights.
Thanks a lot, Farah. Thank you for having me.
And for our viewers, if you would like to read more about Basel Endgame, please head to bankingriskandregulation.com for more content on this important topic. Thank you so much.